Gold, unlike our paper money, is real money. Gold, therefore, will never lose its value because it is intrinsically valuable. Many people and even investors have a complete misunderstanding of what gold actually is. If you look at it from a purely investing standpoint, gold is not that interesting. We at Geopolitics and Money have seen dozens of interviews where contrarian analysts get mocked by conformists when they start talking about gold and also silver. Let's take a look at this much desired precious metal and see what it really is and why you should have gold in your portfolio. Hello everyone and welcome to Geopolitics and Money, the #1 YouTube channel where geopolitics, finance, commodities, and investing intersect. Subscribe to this channel to stay on top of the precious metals market, geopolitics, and investing. Be sure to click that bell button so you'll get notified immediately when we publish a new video. Alasdair Macleod recently published a very interesting article about the role of gold that we will discuss in great detail in today's video. He is a financial analyst, economist, and the head of research at Gold Money. He is known for his research on money, gold, and macroeconomic topics, and has written several articles and books on these subjects. He also frequently writes on financial markets and is a frequent speaker at conferences worldwide. He has over 40 years of experience in finance and investment. His analysis argues that precious metal analysts commonly use an investment analysis approach when reviewing the past year and making predictions for the future. However, he believes that gold is not an investment but money, and that this perspective is misleading for analysts and investors. We highly recommend you read the full analysis that we will link to in the description below. We are not affiliated with or contracted by Gold Money. Our sole purpose on this channel is to inform you about the most interesting analysis about the precious metals markets, geopolitics, and finance. Without further ado, let's dive right in. First, Macleod starts off by pointing out the fundamental error that most analysts make about gold. He writes, and I quote here, "Most of these analysts have been educated to think gold is not money by schools and universities which have curriculums which promote macroeconomics, particularly Keynesianism. If their studies had not been corrupted in this way, and they had been taught the legal distinction between money and credit instead, perhaps their approach to analyzing gold would have been different. But as it is, these analysts now think that cash notes issued by a central bank is money, when very clearly it has counterparty risk, minimal though that usually is. And it is accounted for on a central bank balance sheet as a liability. Under any definition, these are the characteristics of credit and matching debt obligations." This quote should be framed and hung above the bed of every economist, is the humble opinion of our editorial staff here at Geopolitics and Money. When you think about what Mr. Macleod says, it should be a surprise to hear that macroeconomists are unable to provide a clear explanation for why central banks hold large amounts of gold bullion in their reserves, and why some governments also hold gold bullion in additional accounts beyond their central bank's official reserves. The simple answer to this is because gold is money. The effectiveness of the approach taken by central banks and Asian governments towards gold was demonstrated this year when the Western alliance led by America effectively depleted the Russian central bank's currency reserves with ease. Macleod says, quote, "This is the other side of proof that the legal distinction between money and credit remains, despite any statist attempts to redefine their currency as money. That it can be reneged upon further confirms its credit status." What follows in the analysis is an informative graphic that effectively conveys in a single image what the rest of the analysts explain in great detail. The evidence is clear that the value of gold has remained relatively stable over time, both in the long term, looking at its purchasing power measured by commodities and goods, and in the short term, as demonstrated by the example of crude oil prices during the time the dollar was on a gold standard. In 1971, the gold standard was dropped, and just look at the graph again. The oil price in dollars went to the moon. 1971 is a key moment here. Let's go back a few decades in time to 1944, when the Bretton Woods Agreement was signed and how it led up to the 1971 decoupling of the dollar to gold. The Bretton Woods Agreement established the dollar as the world's primary reserve currency, with all other currencies pegged to the dollar. The agreement also established a gold standard for the dollar, with the US government committing to convert dollars into gold at a fixed rate of $35 per ounce. This system worked well for several decades, but by the 1960s, the US was running large trade deficits, and the expansion of dollar credit, meaning the amount of money created by banks in response to increased borrowing, was becoming too great. This led to inflation and a loss of confidence in the dollar. As a result, Other countries began redeeming their dollars for gold, putting pressure on the US government's gold reserves. In 1971, the US government, under President Nixon, officially ended the convertibility of the dollar into gold, effectively breaking the link between the dollar and gold. This event is known as the Nixon Shock. After the breaking of the link between the dollar and gold, the price of oil in dollars began to rise as the value of the dollar began to decline, which caused an increase in the price of oil in dollars as oil is traded in dollars. Also, many countries began to price their commodity, including oil, in dollars, which led to a persistent increase in the dollar's price of oil. The move away from the gold standard was significant as it marked a shift towards a fiat currency system, where the value of money is not based on any physical commodity like gold, but it is instead determined by government fiat or decree. The price of crude oil, measured in US dollars, has been highly volatile, and prior to the financial crisis of 2008, it had risen by 54 times. However, when measured in gold, the price of crude oil had only doubled. This discrepancy raises questions about the suitability of the dollar as a stable medium of exchange, and economists may need to consider the role of gold as an alternative currency. There are several reasons why some investors choose to include gold in their investment portfolios. Diversification. Gold has low to negative correlation with most other asset classes, such as stocks and bonds, which means that it can provide diversification benefits to an investment portfolio. This means that when other assets in your portfolio are losing value, gold can help to balance the overall performance of your portfolio. Hedging against inflation. Gold has historically been a hedge against inflation. The price of gold tends to rise when the purchasing power of fiat currencies with no intrinsic value that are backed by governments, decreases, which is often the case when inflation rises. Store of value. Gold has been considered as a store of value for centuries, which can help to preserve the purchasing power of your wealth over time, in case of currency devaluation or other economic crisis. Safe haven asset. Gold is often considered as a safe haven asset, which means that it can be used to protect wealth during times of economic or political uncertainty. It's important to note, however, that past performance of an asset or an asset class is not a guarantee of future performance, and the gold market is also affected by the many unpredictable geopolitical or economic events that could happen. Therefore, investing in gold should be part of a well-diversified investment portfolio, and as per your financial goals and risk tolerance. That's it for today's episode. We would like to know what percentage of gold that you hold in your portfolio, if any. Please leave a comment below. Thanks for watching. Please subscribe so you'll never miss a new episode. See you in the next one.
The price of gold depends upon which country you live in and what is the value of the money you trade in. But to all you Americans, right now in US dollars, gold is cheap.